Hello, everyone, and welcome to The Explainer. Today, we are unpacking a really fascinating and honestly, a deeply relevant topic. We're going to take a deep dive into the invisible forces that are actively shaping our incredibly stressful modern economy right now. If you've been feeling like the world's financial systems are suddenly speaking a completely different language, one that just doesn't make sense anymore, you are absolutely not alone. So let's dive into this together and make sense of what economists are calling the defining era of our time. We have to start right here with this massive, glaring question. Why does the economy feel so broken when unemployment is historically low? I mean, it's the ultimate paradox of 2026, right? On paper, the jobs market is strong. Yet when you're at the grocery store or the gas pump or looking at the housing market, it feels like a total disaster. It's a completely counterintuitive mystery. And to solve it, we really need to shift how we look at the world. We have to look past our own individual wallets and start looking at the global machinery running the whole show.
Section 1. The invisible architecture, from micro to macro. That frustration you feel when you're just trying to pay for everyday essentials, it isn't just a local issue. It's actually a single gear turning inside a massive planetary mechanism. To really grasp this, let's look at a lecture given by economist Ricardo J. Cavaliero at MIT in the spring of 2026. He laid out this deceptively simple definition. He said, macroeconomics isn't about individuals. It's not systems. It is literally the study of entire civilizations moving together. It's how we all ride the waves of inflation, navigate interest rates, asset bubbles, geopolitical conflicts, and financial panic. It studies this invisible architecture that determines whether a society feels stable and prosperous or just utterly anxious and exhausted.
So there's a really stark contrast here. Think of it this way. Microeconomics is about you. It's about a single household, one worker, or one specific company trying to balance a budget. But macroeconomics? That's the entire system. It's about the vast, interconnected forces moving whole populations around the globe. And by 2026, that massive macroeconomic architecture across the Western world had begun to strain under pressures we hadn't seen since the late 20th century.
Moving on to Section 2, the end of free money, the road to 2026.
To understand how we actually got to this point of massive strain, we have to look at how abruptly we transitioned away from an era we all basically took for granted. Think about it. For almost 2 decades after the 2008 financial crisis, we lived in a world of cheap money, low inflation, and near zero interest rates. We kind of just assumed it was permanent. And then the dominoes started to fall. First, in 2020, COVID-19 shattered global supply chains, while governments injected trillions into economies just to keep them afloat. When the world reopened, demand exploded way faster than supply could handle. Then, in 2022, the Russian invasion of Ukraine triggered a massive energy inflation shock. And by 2026, further Middle Eastern instability and conflict with Iran pushed oil prices up yet again. This specific sequence of events completely shattered that assumption of permanent low inflation, creating a totally synchronized global shock. Which brings us to a phrase you are going to hear a lot, the age of constraint. This new reality brutally squeezed a whole generation of investors, consumers, and politicians who had assumed that economic abundance and cheap borrowing were just normal. All of a sudden, the free ride was over, and everything had a really steep cost.
Which brings us to Section 3, the good news paradox, why boom means bust.
Okay, so with that historical context in mind, let's pivot back to answering our opening question by flipping our intuitive assumptions totally upside down. If you've ever watched the stock market tank on a day when a really great jobs report comes out and wondered what on earth is going on, well, this step-by-step breakdown explains exactly why. Step 1, we get strong employment reports. Unemployment is low. In a normal world, that's awesome. But under the age of constraint, we immediately move to Step 2. Companies have to compete for workers, which pushes wages higher. If those wages outpace productivity, companies have to raise prices, which fuels inflation. That triggers Step 3. The central bank, like the Federal Reserve, is forced to step in and raise interest rates to cool down all that overheated demand. And finally, Step 4. Higher borrowing costs mean corporate profits and asset valuations drop. So modern financial markets literally crash when jobs reports are too strong, simply because it guarantees borrowing money is about to get way more expensive. It's wild, right? But this brilliantly illustrates how modern finance has fundamentally changed. It is now deeply psychologically tied to monetary policy. Traders just do not celebrate economic strength anymore. Instead, they view absolutely every single piece of economic data through one lens. How will central banks react to this?
Strong payrolls, the market panics about rate hikes. Weak inflation, the market rallies hoping for rate cuts. Monetary policy has basically become the central organizing force of modern capitalism.
Section 4. Global dominoes falling, a planetary system. Now, this isn't just an American story. Let's zoom out and take a rapid-fire global tour to see how this macro squeeze manifests in totally unique ways across different nations. Over across the Atlantic, Britain found itself trapped between stagnant growth and soaring borrowing costs. These rising rates exposed real fiscal vulnerabilities, fueling political instability and major volatility in their government bond markets, pretty much regardless of who was actually in power. Over in Europe, the vulnerability was entirely different: deep energy dependence. Following the Ukraine war, higher energy costs embedded inflation directly into Germany's massive industrial base and into everyday household goods. And what about Canada? Well, their primary vulnerability was household mortgage leverage. Because Canadian households carry some of the highest debt burdens in the developed world, rising central bank rates immediately triggered a middle-class mortgage crisis, which instantly froze consumer spending.
Meanwhile, the United States remained highly resilient, but also incredibly dangerous to the rest of the world. Why? Well, because of the US dollar's dominant global role. Whenever the Federal Reserve adjusts its rates, it instantly affects global capital flows. When US Treasury yields rise, America is effectively exporting its tighter financial conditions to the rest of the world. That puts massive pressure on emerging markets and foreign currencies everywhere.
And then, of course, we have China. After years of really strict zero-COVID policies, China's aggressive reopening in 2026 created a massive new complication. Now, you'd think a booming Chinese economy would be good news for everyone, right? Well, the irony here is that a strong Chinese rebound creates an absolutely massive demand for global commodities, and that threatens to push prices higher everywhere, risking a brand new wave of global inflation right when Western central banks are desperately trying to cool things down.
Section 5. The age of trade-offs, balancing risks. Because what made 2026 so uniquely unstable was that perfect solutions just didn't exist anymore. We have fully entered the age of trade-offs. This is the impossible dilemma facing policymakers today. On one side, you have raising rates. This is great because it controls inflation, but the trade-off is it severely weakens economic growth and skyrockets the cost of debt. On the other side, you have cutting rates. Now, this supports growth and relieves all that debt pressure, but it risks reigniting that incredibly sticky inflation we all just fought so hard to defeat. In this kind of environment, every single economic solution immediately creates a new crisis. Honestly, it requires a massive amount of newfound humility from economists. And because of these brutal trade-offs, we see this fascinating, almost scary cascade effect. It's like a giant line of dominoes. Inflation connects to labor markets connect directly to interest rates, those interest rates dictate asset prices drive consumer confidence dictates politics and elections, politics drives a nation's fiscal credibility determines a country's bond yields, and finally, those bond yields connect right back into global capital flows. It is a relentless planetary system of interconnected feedback loops. A jobs report in America can literally alter commodity prices in Latin America, and in turn influence political destinies in Europe. Everything is connected. Which leaves us with this final, incredibly provocative thought to chew on. Governments everywhere promise their voters growth, better services, and tax relief. But the global bond markets, they demand discipline, restraint, and strict inflation control. When these two forces collide, as we've seen them do across the globe in 2026, governments very quickly lose their room to maneuver. So in an age where the era of free money is definitively over, where abundance is gone and constraints rule, who really controls our future? Is it the voters at the ballot box or the invisible planetary architecture of the bond market? It's a huge question, and understanding the macroeconomics behind it is really the only way we can begin to find the answer. Thank you so much for joining me for this explainer. I hope this helped make the invisible architecture of our world just a little bit clearer for you. See you next time.